Have you ever wondered why the rich get richer and others don't? Could it be that a small percentage of the population seek out others to find, study, and execute on legal loopholes that exist within our financial life and make it easier for them to prosper? The answer is a resounding yes. This is the Secrets of the Wealthy podcast with John Mintz. John has spent a lifetime researching and mastering the financial loopholes that he believes should be available to everyone. Join us as we explore different strategies that help you get farther faster towards building and enjoying a prosperous retirement.
Hello and welcome to the Secrets of the Wealthy podcast with your host, John Mintz. I'm Wendy McConnell. Hi, John. How you doing today?
Hey, Wendy. I am fantastic. New voice on our show today. So first thing I want to do is welcome you to the show. You know, we ended the last show with explaining to the audience why Eric was leaving us, and obviously he was going to something very special and important. So we wish him all the best. Yeah. But we're excited to have you on the show as well, Wendy. And I want, for the benefit of our audience, why don't you tell our audience a little bit about yourself and your background and why you chose to join our show.
Well, I am honored to be here with you on the show, and I have been doing this type of work for the last couple of years. I spent most of my career in radio broadcasting, but now I am happily living at the Jersey Shore.
Jersey Shore. Yeah, I know when you mention that, I know what comes to mind, but that is not the same Jersey Shore for you, is it?
No, you're thinking of the show from MTV, right?
Yes.
Yes. That's actually not far from where I live. It was filmed about 20 miles north of here, and maybe in the 20s. Yeah, that it might be a little bit like that, but not now.
Well, maybe more about that on another show. But so glad to have you on with us. And I'm sure we're going to have a lot of fun together, and I'm hoping the audience enjoys it as well. So let's get on with the program today, right?
All right. Thank you so much for having me, and let's get a market update.
Super. Now, I usually spend 5, 10, 15 minutes on a market update today. I'm not going to do that for the benefit of trying to get in the remaining information on the series that we've been doing. But I did want to highlight one thing that came out this week, kind of unexpected. You know, inflation had been coming back down. I think we got as high as 9%, and it got all the way back down to 3.1%. And it seemed like it was going to be holding. And then we get this week's report, and it jumps back up to 3.7%, which doesn't sound like a big jump, but it really is. A lot of that was attributed to gas price increases.
Oh, yeah.
Right. But people were already hurting, and now that just makes matters worse. And so what the Fed will do as a result of that, I don't know, but I can't imagine they'll lower rates after that happened, because this inflation is just sticky, isn't it?
Yeah, it's really causing a lot of people a lot of pain. Yes,
for sure. Well, anyway, that's the end of that. I don't know where the markets go from here. They're still showing some positive signs, but as usual, I'm like a broken record when I say this. I just remind folks, especially those who are approaching retirement, to stay balanced. Balance is key. So we'll move on from there. But we're in the middle of a series, right, called Taxes in Retirement, and let me just give a quick review of what we've covered in the first 2 episodes. And I do believe this will be the final episode of a 3-part series. In part 1, we called that Plan for Your Taxes. We gave a history of taxation and where taxes have been, where taxes are, and maybe where tax might go from there. In part 2, we reviewed, are you retiring to a lower tax bracket? Most folks don't. And so if you are not retiring to a tax bracket, then you'd want to tune into part 3, which is retirement tax strategies. And so this is probably going to be the funnest of the 3 episodes, but it's important to listen to the first 2 if you haven't already, so that you understand the pieces that we're going to be talking about today.
Okay.
So, Wendy, let me to get our show this episode started off. Let me ask you a question.
Okay.
Have you ever had anyone teach you a trick or a loophole that you really didn't know existed, but you were so happy to learn about it, and then you think, "Wow, how could I not have known this sooner?"
Yeah, I fear that you're going to ask me for an example, but I know what you mean. And
Yeah, no, I don't need. If you think of an example, feel free to bring it up.
I'll just shout it out later in the show.
Well, now the audience knows that these shows are not pre-planned, right?
Right.
Like, yeah, I'm not like a teleprompter, like maybe one of our presidential former presidents that have teleprompters telling them how to respond to everything. But and the reason I asked that question, I'm sure as I'm asking the audience this question too, that we pretty much can all think of a time where we discovered something in our life thinking, man, if I'd have just known that 10 years ago or 20 years ago, wow, how much better it would have been.
Right.
And our show is called The Secrets of the Wealthy. I should put in parentheses next to that, revealed. Right. And I don't have that. Maybe I should. And the reason is because we don't believe that these secrets should be secrets. We believe that that's the purpose of the show, is to help folks realize what's available to them, what's out there, so that they can benefit from them. In fact, episode 11, we call it Travel Hacking 101. And it's just all about travel saving secrets. And so, I tell a lot about what I learned from that. But just this past week, my wife and I have a cruise first quarter of this next year. And it's a cruise that leaves from San Juan, Puerto Rico, and goes to a number of different places. So we're excited. We've never been to Puerto Rico before, but when we do this, we usually go in a couple nights early. One, just in case flights are delayed, we don't want to miss the boat.
Right.
And two is so that we get a chance to, hang out and see the local community before we leave it. So I got online, started looking around at a couple different places. We found a Grand Hyatt a little ways down from the pier, the cruise pier, and it was charging $564 a night. Okay?
Wow.
Yeah. And that was one of the cheaper ones, by the way.
Oh.
I saw the prices go. I don't know what's happened to the travel industry. I saw prices. You're not going to believe this when I tell you this. Prices per room went as high as $20,000 a night.
For a hotel room?
For a hotel, in a resort, yes.
Oh, my goodness.
And I'm not going to say who the resort is because I don't want to embarrass them. But I guess if you have the money, it's okay. But I don't spend $20,000 for a hotel room. But
me either.
Anyway, long story short, instead of paying $564 a night, my wife and I are going to pay nothing. Just simply using 43,000 points on our Hyatt travel, and we're going to stay for free, including taxes and the whole 9 yards. So that is a hack that I teach in that episode 11. But the point of that whole story is this. Why did I tell that story? Because before I learned how to do that, we were ignorant. And if we would not have learned that, then we'd still be suffering, paying these higher prices that doesn't really need to be paid. So that's kind of how I believe folks feel after they learn, how, to efficiently use the reduction and optimization secrets that we teach as it relates to taxes and retirement.
So when it comes to the hotels, you have to join their club or, whatever it is that they offer in order to earn the points. Yeah,
that's what most people think, actually. But as we teach in episode 11, it's way beyond that, because earning points through just joining their travel program and then just staying there, it's like running in mud. You can't really get a lot of benefit from that.
Okay.
But there is loopholes and systems that you can learn that you can get significant bonus points that allow you to accumulate. I think the last time I looked, I had about 2.5 million points.
Oh, I'm going to have to go back to episode 11.
Yeah, I think so. It's fun. And every 10 to 15 episodes, we do a fun episode just because it's fun. So, and I like to have fun. But so, yeah, anyway, on that note, let's talk about some loopholes, some hacks that can help some folks just like that one.
All right. Sounds good.
All right. So we're talking taxes today, right?
Mm-hmm.
And before I kind of get into some of these strategies, I just want to help people understand that there's really three buckets of taxation, so that people understand kind of where taxes go and why they're taxed and that sort of thing. And then we'll spin off of that. But the first bucket is what I call the tax deferred bucket. So now when I'm in teaching this in workshops and that sort of thing, I actually have a big red 5-gallon bucket, and I hold it up and I say, okay, this is your tax deferred bucket. And when you bring your statements in for us to review them, then you're going to bring a statement in. It's going to be pretty thick. These are your 401ks, your IRAs, your 403bs, your pensions, those kind of things. Yep. And the reason there's going to be a lot of that is because this is where approximately 91% of American assets lie. And it's inevitable. Every time somebody comes in, this is what I see. They have the majority, if not all of their money in their 401ks or former 401ks, IRAs, right?
Right.
Sitting there.
We all wanted to hold off on those taxes.
Yeah, because that's what they were told to do.
Right.
They just did what they were told to do. It's not necessarily their fault, right?
Yep.
So then I pull out inside of the big red bucket, I pull out one of those red solo cups. You know how big those are, right?
Oh, yes.
So I pull one of those bad boys out and I say, okay, this is going to be your taxable account. You're going to bring this in and you're going to hand that over to me and we're going to review that. These are like your CDs, your money markets, your brokerage accounts, joint accounts, irrevocable trusts, your after tax, you're going to be paying tax on the growth. Everybody understands that. And then inside of that cup, I pull out the mini solo cup, the mini red solo cup. It's like a shot glass, right? Yeah. And I say, this is your Roth IRA that you're going to be bringing. Inevitably, everyone laughs, right? But it's not really funny, truth be told, because most folks, that's representative of what they have in a Roth or nothing, right? And so it's probably the most misunderstood of the three tax types, truth be told. CPAs get it wrong. Clients get it wrong. Heck, even financial planners get it wrong. And, for example, did you know that anyone can have a Roth IRA?
No, I thought that it was something that had to do with work. Yes.
So a newborn to a 100-year-old can have a Roth. Even retirees can have a Roth. And this is a myth that a lot of folks know. And in fact, over 96% of employers with 500 or more employees offer a Roth version of the 401k. 96%. So people could be contributing to a Roth through their 401k, but less than 10% of those same employees know it's even there.
Yeah, I don't think it's very widely publicized. I don't think that many people know about it.
Do you know why?
I don't know why. It's so much more beneficial for us, right?
I know. I'm about to tell you. And even worse than the 10% is less than 4% participate. Okay. I see it all day, every day. People come in. I ask them, okay, do you have 401k? Yep. Are you contributing? Yep. Do you contribute to the Roth IRA? I don't think I have one. Of course, we call, and of course they do. And the reason why they're not participating, or they don't even know it's there, is because they're not educated about it. And like you just said, right, Wendy? So why are they not educated about it? And here's the reason. It would cost employers millions and millions of dollars. So I'll give you an example. One of our local employers here, large employer, I have a lot of clients from this employer, is Lockheed. Everybody knows Lockheed, right? Mm-hmm. And they have somewhere around, 115,000, 120,000 employees. So imagine this. If Lockheed had all of their employees switch from tax deferred contributions to Roth contributions, yes, the employee would pay taxes, but guess who else would have to pay taxes?
Oh.
Mm-hmm.
Never thought about that.
Lockheed would have to pay an additional, in the state of Texas, an additional 8.25% employer payroll tax on all of that money.
Wow.
So is it in their best interest?
No.
Have folks? No, it's not. Of course not. It's not in their best interest. So, so that's just an example of people. This is what I mean by us being ignorant and us not knowing, like that story I told about, traveling for free. It's the same thing. Now, if someone listens to this show and they just hear that, now they're going to go back and look and say, oh, I do have a Roth IRA. We just changed the lives for that person for the better. This is why I love this show. But anyway, we have many different ways of getting money into tax-free accounts, and I don't have time to cover all those today, but I am going to cover a few tax strategies that I think people will have a lot of fun discussing.
Okay, let's hear 'em.
But in essence, our goal is to systematically help folks move money from that tax deferred bucket to that tax free bucket, from that big 5-gallon red bucket to that mini solo cup bucket. And so by doing so, if we can just smooth those out, like we have some clients where we move them all the way across. And it's really nice to sit across the table from those folks and say, hey, guess what? We're done. You're tax free for the rest of, duration. But if we can just smooth those buckets out, even them out, in general, we're going to save generally a little over $200,000 on average in taxes over time.
Well, I like that.
Yeah. And so we do that. We have fun with that. We'll sit with folks and we'll say, hey, how would you like for me to personally would you like to save $100,000 in taxes today at this class, right? Oh, yeah. Well, how about I personally hand you $100,000 tonight? And their eyes get big as, goose eggs, right?
Right.
And so later in the class, I actually hand out a couple $100,000.
Okay. How?
Well, you ever had that $100,000 candy bar?
I have. They're delicious.
There you go. So we don't lie. We hand out $100,000.
Oh,
John. But then we say, okay, all kidding aside, we really can save you $100,000 and do so. It doesn't happen overnight usually, but it happens over time. But we really can. Mm-hmm. So another thing we do is we pull out a slinky, and I have to explain this because people can't see this in person, right? But I mean, when's the last time? Be honest. When's the last time you played with the slinky?
Oh, it's been a long time, but they're so fun.
Oh, no. Tell me about it. Well, I just played with one this last week. But so we take a slinky, and if you're holding it in your hands and you kind of go up and down, up one hand, down the other, and back and forth, that slinky kind of makes a reverse U shape, right? Mm-hmm. And so we kind of use that to explain this is going to represent the volatility in the markets. And so the markets go up and the markets go down. They go up, they go down. And then I take the slinky and I stretch it out from top to bottom, like from the roof to the floor. I kind of stretch it out like that with my two hands. Mm-hmm. And I say, let's just say that when there's volatility, there's also opportunity. So let's just say that you owned $100,000, and I'm stretching out the slinky. I'm saying, let's just say you own $100,000 in Berkshire Hathaway stock. And that's a really expensive stock and a very popular stock. And then I say, this is pre-COVID, and you have this in an IRA, and then COVID hits. Okay. And this is the true story. If that was you, COVID hit, and your $100,000 went to $58,000 in 4 weeks.
Right.
Okay. And then I take the stretched out slinky and I kind of pull it down about 58% of where it was stretched before. And then I ask the group, what do we do then?
We wait.
That's what everybody says. We write it out. We write it out, right? Don't sell. Write it out.
Right.
But what if instead of doing that, we convert it to a Roth IRA? What if we convert it to a Roth IRA? Then It rebounds. I'm stretching the slinky back up again. And then it rebounds to 100 grand. But what did we pay taxes on?
58.
Yeah, exactly. 8,000. So then it grows to a record high tax-free. And so if folks that are listening in, if your advisor or whoever you're working with is not helping you with the timing of Roth conversions or tax harvesting, and we just represented both right there in one strategy, then you really are missing out. I mean, this is the type of advice you might be missing out on if you're not with somebody that is what we call a true holistic planner that really looks at all the pieces as it relates to your retirement, right?
Yeah, I mean, that was fascinating, John. I love that.
Well, good. Well, okay, well, let's finish with some rapid fire strategies because I know the time tends to get away from me on these shows, but that you could actually execute on and save yourself some serious taxes. So, I ask folks if they donate to charity or churches and they're not getting any benefit due to the higher standard deduction.
Okay.
Right. And inevitably, there's always someone that is doing that. And then we ask if they know what a QCD is. So you know what that is, I assume. Yes?
No.
Yeah. Okay. So QCD stands for Qualified Charitable Deduction.
Gotcha.
So if you're 70 and a half, and you have to be 70 and a half to be able to do this, and we do this with our clients, for our clients, then you're able to distribute up to $100,000 out of your retirement account, your IRA, 401k, what have you, to a church or qualified charity. But here's the best part. So let's just say you're 70 and a half, you're donating, you're 71, whatever, and you're donating $10,000 per year. Well, it really should be going directly from your tax deferred account. The reason is because if you do that, you can completely avoid paying taxes 100%.
Like it.
So if you pull it out first, and then you donate it to the charity, then obviously you're going to have to pay taxes on that. So we handle all of that for our clients, and it'll allow you to save a ton of taxes over time. All so one last thing, we talked a little bit about Roth conversions, and I'll close with that. Roth conversions ran before we got on the show here today. I ran a 64-year-old with a $500,000 IRA. He's in a 25% tax liability, and let's assume he's going to get 5% annual growth from 64 to age 90. We're just going to let him live to a ripe old age of 90.
Well, that is very nice of you.
Yeah, no. And then we run his taxes. Here's not the not so nice part. We run the taxation he's going to pay on that money over that period of time. And the taxes that he'll pay on his original balance of $500,000, is going to be hard to believe, is $456,868. Now, here's the worst part. That's without us increasing his taxes and his tax brackets over time, which we all know and agree that's going to happen.
Right.
But if we convert those IRAs, that IRA to a Roth IRA, well, if he's in a 25% tax bracket, that's going to be $125,000. And that's it. He's not going to pay taxes on the growth. He's not going to pay taxes at death. So now his total taxes are $125,000, which is a 73% reduction from the $456,000 he would have paid.
So, John, my question is, can you take that out of the money?
You can.
The $125,000 without being penalized?
Yeah, that is absolutely 100% correct. So if you have $100,000, for example, you have two choices. We can either have that tax automatically taken out with the conversion, so it doesn't come out of another account, it doesn't come out of your budget, doesn't come out of anything else. And now that $75,000 is going to grow from there tax-free. Or we can convert the entire $100,000 so the entire balance stays in the Roth, which is what most people prefer. They want more money in the tax-free bucket. And then we can pay that tax out of some sort of after-tax account which a lot of folks have cash sitting on the sidelines right now. We'll just pay the tax out of an after-tax account somewhere else.
Okay.
That way we keep more money in the Roth. But yes, the answer to your question, Wendy, is we can do it either way, and we do.
All right. I like it.
Super, super. And so I could keep going. Like I said, we have many, many ways to get money over into, out of that big 5-gallon tax deferred bucket in that little tax free bucket. We have many ways to do that, but unfortunately we don't have all day to talk. So that's more material for another show, right? But we're going to wrap up this taxes and retirement series today. And I just want to say again that I'm excited to have you on the show. I'm excited to learn more about you and you learn more about us, and we'll see where this goes.
Well, John, this has really, truly been a blast. I really am so happy to be here. So if people have more questions, how do they get in touch with you?
Well, there's a number of different ways to reach out to us. But before I give that, you think this is fun. Just wait. I was easy on you today. Wait for the next one.
I can't wait.
No, I'm kidding. So, but how they can reach us is our direct number. And we do answer the phone, Wendy, during normal working hours. It's 817-225-6260. Or they can reach out to our website and contact us that way if they'd like to do that at Biltmore, BILTMORE-financial.com.
All right. Thank you, John. I appreciate being here, and I look forward to the future. Thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Secrets of the Wealthy podcast with John Mintz. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of John Mintz. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.